Welcome to the Collier County Foreclosure Task Force event, which is our free foreclosure public policy forum. We have a full agenda for you tonight, so we're going to get right to it. Part one is going to be a discussion of federal programs, loan modifications, and other information that you'll need to know. This event is designed to be of great, we hope, help and information for not only homeowners, but also to those who are on the board of directors of homeowners associations, condo associations, also to realtors and other interested folks who want to know what kind of resources are available in the community, free, safe, and reliable resources in the community for those who have questions about the foreclosure process and the effect of foreclosure on our community. So without further ado, it's part one is going to be the loan modification process, federal programs. We're going to talk about short sale process after that. Following that presentation, there's going to be a discussion about deficiency judgments, collection activity, what we call the end game. Also some myths and urban legends that you need to be aware of. And there'll be a discussion in depth about condo associations and homeowners associations and resources available to them, good information about their rights and obligations, and also remedies available to homeowners associations, and a discussion for realtors on the short sale process, because I know that there's a lot of technical information that realtors need to know. That will be the end. I'll also talk about very briefly at the end of that part one about resources available, how you can find out more information about where to go for help or information, and I'll conclude part one in my presentation. Then we're going to have a 5-minute break, at which time, during that break period, if you want to have a question and answer session with any of the expert panelists that appeared during part one, there'll be breakout sessions. You'll go through the back doors and then down the hallway. There are 2 meeting rooms after part one is concluded where you can discuss with the panelists and other volunteer members of the task force any questions that you have of a general nature. They're not going to be giving legal advice. They cannot do that. They won't be doing that, but they will answer general questions and provide you information. Then after the 5-minute break, we've got a really nice program in part two. You're going to hear about the coordinated community response, not only the efforts of the foreclosure task force since 2008, but you're also going to learn about the efforts of Collier County Code Enforcement in their blight prevention program, and also the great efforts of Collier County Sheriff's Office with respect to the community safety teams initiative. So without further ado, I'm going to turn this now over to Michael Puchalla of Housing Development Corporation. Michael?
My name is Michael Puchalla. I am a certified foreclosure intervention counselor with Housing Development Corporation of Southwest Florida. We're a local HUD-approved nonprofit counseling agency right here in Naples. Today I'm going to be briefly discussing programs and procedures available to struggling homeowners who are interested in retaining their primary residence property. We're going to begin with an overview of the loan modification process. A loan modification occurs when the owner of a mortgage agrees to alter one or more of the following elements of a loan: the interest rate, the term, and/or the principal balance through either a forgiveness or a forbearance. It is important to understand who the true owner of the mortgage is. The institution you make your mortgage payment to is typically a servicing company. They collect payments on behalf of an investor who has the ultimate say in whether a loan will be eligible for modification assistance. Even though the decision lies with the investor, homeowners who seek assistance will typically work through the servicing company when they request help. Every file is reviewed independently to determine the individual household's ability to pay. We'll need to determine total gross household income, and it will need to be verified, and the lender's also going to review household expenses. The level of modification assistance will vary depending on the individual household's financial circumstances. It definitely helps to research and understand the programs that are available before requesting help from the bank. In March of 2009, the Department of Treasury announced the Making Home Affordable initiative. There are currently 3 major components of the initiative, and these are the Home Affordable Refinance Program, better known as HARP, the Home Affordable Modification Program, or HAMP, and the Home Affordable Foreclosure Alternatives Program, better known as HAFA. HARP provides an option for homeowners who have stayed current on their mortgage payments to be able to refinance and take advantage of today's low interest rates, even though property values have dropped below normally accepted levels. And this is typically accomplished by the lender allowing a waiver of appraisal and not looking at property value as a determining factor in the loan eligibility. The investor or owner of your mortgage must be either Fannie Mae or Freddie Mac as of today to participate in this particular program. Homeowners have the opportunity to work with any participating lender to obtain competitive pricing on the new loan, but income must be documented and sufficient income must be proven to cover the new mortgage payment along with all other household debts, and of course credit is going to be reviewed as well. The more widely used retention program available through Making Home Affordable is HAMP. Any servicing company or investor is eligible to participate in this program, and there are actually financial incentives for each successfully modified loan. We, as a task force, have previously covered a detailed loan modification case study using the HAMP model, and there's a link to a video presentation of this case study available on the Collier County Task Force website at www.collierftf.com. I encourage anyone interested in learning more about the loan modification process to take a look at this video. Now, most investors, including Fannie Mae and Freddie Mac, will review files for in-house or backup modification programs in cases where HAMP is deemed to be ineligible. These reviews are typically initiated automatically using the same paperwork that was already submitted, but you do need to be aware that additional financial documents are going to be requested and need to be updated frequently. It is important to read any denial letters which are received from the servicer thoroughly to determine what other options may exist. A denial may lead to another option, and you want to be aware if there's another option, what steps need to be taken. Treasury has recognized that it is not financially feasible for every single homeowner to be able to retain their property. This led to the creation of the HAFA program, which is going to be discussed in greater detail by my esteemed colleagues in the upcoming short sale presentation. As they say, all good things must come to an end, and we do have some expiration terms on these great programs. The Making Home Affordable programs were actually initially scheduled to expire at the end of 2012. Treasury has provided some extra relief and decided to extend all of these programs through the end of 2013. The Mortgage Forgiveness Debt Relief Act of 2007 is set to expire at the end of 2012, barring an extension. This program was created to provide an automatic exemption to having to pay income tax on mortgage forgiveness on a qualified principal residence. You can learn more about this act at the irs.gov web address that's up on the screen, and I know it's a lengthy address, so I want to let people know this presentation will be on the collierftf.com website in the near future. We encourage all struggling homeowners to be proactive in seeking professional assistance with all legal and tax matters. Getting the information that you need and making sound decisions now regarding an underwater mortgage can have a huge impact on your future, financial future. In 2010, Treasury took additional steps in identifying states which have suffered the greatest impact due to the foreclosure crisis and provide targeted funding to these states. And I don't believe it comes as any surprise that Florida ranked very high on this list. Our state has received an allocation of approximately $1 billion through the Hardest Hit Fund program. The goal of the program is to provide mortgage payment and/or reinstatement assistance to homeowners who have become unemployed or underemployed through no fault of their own. There are some very exciting changes that are presently taking place. We've been quite busy reviewing files that were initially deemed ineligible. These changes are going to allow many more homeowners to obtain assistance through the program and for a longer period of time. We encourage you to visit the Hardest Hit website at www.flhardesthithelp.org and make sure to use the correct address. There are some scam sites out there. You want to get more information or to start an application into this program. If you would like to speak with somebody locally, our office is available as a local advisor agency for the Hardest Hit program. You can contact us by visiting www.collierhousing.org, and if you call or email, just ask to request to speak with a Hardest Hit program advisor. In closing this evening, I would just like to stress the importance of taking a proactive approach for anybody who's struggling with their mortgage payment. There's free local assistance available to guide you throughout the process. Take advantage of the great resources that are available on the www.collierftf.com website. And at this point, I would like to turn the presentation over to Francesca Passeri and Toni Stout to discuss the short sale process.
I'm here to talk about short sales. We're going to move pretty quickly. There's a lot of information that I'm going to go through, and I'm going to stay pretty much on the slide presentation. If you have questions after our presentation, feel free to talk to Toni or I about them. What is a short sale? A short sale is when the mortgage holder has to approve the sale because there isn't enough money coming from the purchase price and all of the ordinary closing costs to cover paying the mortgage balance off in full. So it's short, and that's why it's termed a short sale. There are several different types of short sales. Michael referenced the half a short sale, which is the government-sponsored program. It stands for Home Affordable Foreclosure Alternative. Those are all Fannie and Freddie loans are eligible for the half a program. They're all the major lenders also have traditional or in-house programs. Bank of America has something called a cooperative short sale program. Anything that's not a half a short sale basically can kind of lump into the other program in which the lenders will make the criteria for the program. But with HAFA, as I said before, Fannie and Freddie mortgages have to participate in that program. All other mortgage holders may elect opt-in. And there is a list available on the Making Home Affordable website where you can look up your lender and determine whether or not they're participating in HAFA. The benefit of HAFA is that there's a deficiency waiver on the first mortgage, and if there's a second mortgage, it will also be on the second mortgage. There's a $3,000 moving allowance, and for those of you who are familiar with the program, they just made some changes. That moving allowance is payable to the primary occupant. If the homeowner has moved out and put a tenant in place, that tenant is now eligible to get that moving allowance, and that's brand new as of January 1st. Also, the allowance to pay the junior liens on all of the non-Fannie and Freddie has gone from $6,000 allowance to pay the junior liens to $8,500. And your junior liens are things like your HOA fees, your condo fees, any judgments that are out there, any tax warrants, and second mortgages. Actually, second mortgages are not part of that. This is $8,500 in addition to your second mortgage. The HAFA program will expire at the end of this year, and if you have an application in process, there is a period of time that you have to close that. It's important to note that even if you do not have a HAFA eligible short sale, the traditional short sales may still allow for a deficiency waiver for the borrower. Okay, I'm referencing a deficiency. So what is a deficiency? In a short sale scenario, the deficiency is the difference between the mortgage balance on the date of closing and the net proceeds that are payable to the bank. In a short sale, the borrower does not get anything out of the short sale other than a moving allowance or the incentive that the lender allows. So your borrower is really not getting any proceeds. All the proceeds are going to the lender. And if a deficiency is waived, it means the lender's saying, we're going to take this money at closing and we are not going to come after you, borrower, for the balance of the debt. And the deficiency waiver can have a tax consequence, so it's very important that if you're a borrower and you're considering a short sale, or if you're a professional, a real estate professional, and you're representing people in a short sale scenario, that you tell them from the very beginning to seek competent either legal advice or advice of their CPA so that they understand that they may be taxed, and what happens if the deficiency is waived and it's a taxable event. Say there's a $100,000 deficiency, it'll be added on to your borrower's ordinary income at the end of the year, and it pushes them into a higher tax bracket, and they're taxed on that higher tax bracket. So it's still better than having to repay the entire mortgage debt, but they need to know what they're getting into. They'll be very unhappy with you if at the end of the year they find out when they get a letter from the IRS. Okay, for HAFA qualifications, as of June 1st, the occupancy requirement has been eliminated for non-GSE loans. That's government-sponsored loans. That's the Fannie and Freddie. So if you have a non-Fannie and Freddie loan, you don't even have to occupy the property now to be eligible for HAFA. Your borrower has to have a documented financial hardship. Being underwater in your mortgage, in other words, owing more on your mortgage than what your house is worth, in and of itself is not a significant enough financial hardship to qualify you for a short sale. So you have to have some other hardship. It could be a reduction in income, health issues, increased expenses, and generally it has to be a permanent in nature, meaning it's going to extend more than a couple months. Okay, your mortgage balance at the time that you make application can't exceed $729,750. And the mortgage had to have been obtained prior to January 1st, 2009. And as I said before, the HAFA program will end at the end of this year. But if you have something under contract to make application, you have until September 30th of 2014 to close. So there's still a pretty good opportunity here to participate in a HAFA short sale. There are some program qualifications, additional program qualifications. You can't have any significant mortgage-related, tax evasion, any kind of criminal conviction and still qualify for this program. And you can't have purchased another home in the last 12 months. So say you're representing somebody or you are that person and you think that you want to go buy something else and then you'll short sale the house you're in. Be advised you're not going to qualify for HAFA. You may still be able to do a short sale, but it will not be a HAFA short sale. If the borrower is eligible for a modification but just decides, I don't want to keep this house, I want to get out from underneath it, doesn't make sense for me to modify my long-term plans, I would rather just sell it and start over, they're eligible. And it has to be an arm's length transaction. What this means is you can't sell your house on short sale to a family member, a business partner. You can't agree to lease it back. You can't have a stake in the outcome. It really has to be a stranger-to-stranger transaction. If you have a Freddie Mac loan, there's a little bit different process with Freddie Mac. The Freddie Mac HAFA short sale has to be approved in advance. You can't have a contract when you make application. So that's a really important distinction between every other kind of HAFA short sale. And the borrower has to be more than 60 days delinquent and have cash reserves less than the greater of $5,000 or 3 times their current monthly mortgage payment. So again, it goes back to demonstrating that financial hardship. Michael touched on this, and it's the difference between the servicer and who is the ultimate investor who holds your paper, who owns your note and mortgage. The servicer is the lender or company who sends you your mortgage statements. If there's a foreclosure action, they'll be the one usually who brings a foreclosure action. They will negotiate your short sale. They'll negotiate modifications. So they're the front person. The investor is the back party. That's the party that actually owns the paper. And these are often different. Sometimes they're the same. Sometimes Bank of America is your servicer and Bank of America holds your paper. But sometimes Bank of America services lots and lots of loans that they don't own. So it's an important distinction that you know this, because it is going to affect how you go forward in the process and what short sales you're eligible for. And I've put on the slide 3 different lookup tools so you can determine what kind of, who owns your note. There's the Fannie Mae lookup website, the Freddie Mac lookup, and then MERS. MERS is a registration system for mortgages on the secondary market. And if you look on your original mortgage, you can also look in the public records on your recorded mortgage. If there's an 18-digit number that says MIN, that's your MERS identification number. And you can go to this website and put that number in, and it will tell you who your servicer is and who holds your note. And if you're looking it up for somebody else, they'll ask you for personal information like social security numbers to make sure that you have authorization to get that information. So you can't look up your neighbor's information. To have a successful short sale, begin with using qualified professionals. You don't know what you don't know, but it's because of the tax consequences and the legal consequences of deficiencies and waivers. You know, consult with a CPA, know what the tax implications are. You know, use a qualified attorney who can help you through this process. Use a qualified realtor who understands the process. Begin by determining who services and owns a note. That's the first thing that I do when I get a new short sale in is I look it up. I find out who I'm dealing with right from the gate. Then I get an application. And that application will tell me everything that I need to submit to get from the borrower so that I have the complete package. You want to properly document the hardship. Like I said, a hardship is the threshold analysis for whether or not you get to go forward. So explain, you're going to have to write a hardship letter and explain to the lender what your situation is or what your borrower's situation is that would qualify them for this relief. The property has to be listed for sale with the realtor. It's very hard, if not impossible, to do a short sale on a property that's for sale by owner. I haven't done one yet. I'm not saying it couldn't be done, but generally they want to see that the property is listed, it's on MLS, and that they're getting a good pool of potential purchasers so they get the highest value for the property. Like I said before, use an experienced realtor, use an experienced attorney. You'll want to obtain the current statements for all of the junior lien holders, the second mortgage, condo assessments, HOA fees, unpaid property taxes. I just did one where somebody failed to tell me about a couple tax warrants. Tell your attorney everything that's out there is a lien on the property, because we usually don't do a lien search until after we get short sale approval. So if there's something at the very beginning, you have to go to the lender and tell them everything. You have to give them a list of everything that you want them to absorb, because in a short sale, the lender's paying all of the closing costs. If something's not on that list, it's not going to get paid. And if the borrower doesn't have the money to pay it, then you get to start all over again with submitting the application. So it's really important to fully advise your professionals that are helping you what liens are out there. If you owe child support, you know, if you're not current in your alimony, tell your professional so that they know going in, because a lot of these things can be remedied, but we need to know in advance. Accept only offers that allow sufficient time, not less than 45 days, to obtain lender approval. I can't tell you how many times I get contracts that say 30 days. And it's really hard to get that done unless there's already been one failed attempt and the lender has all the documents. So again, a good contract will set everybody up with realistic expectations so that it can go forward as smoothly as possible. Assemble a complete short sale package. Do not send things in piecemeal. The lender will not process your application. If you're lucky, they will tell you that something is missing. If you're not lucky, they will just pitch it. And you'll spend weeks waiting to hear from them as to what happened with your short sale, only to find out that they no longer have it because you didn't send in everything. That's better than it used to be, but you know, keep in mind, they're dealing with tremendous volume, and anything that you can do to make that negotiator's job easier is really going to pay off. Maintain weekly contact with your servicer. There'll be an assigned negotiator at some point in the process after you send the application in. Call that person, email that person, leave that person messages, fax that person. Is there anything that you need? I use that opportunity to try to create a relationship so that they know me, they know my borrower, they care about my file. Okay, if you're asked for additional information, get it to them quickly, because what happens is the pause button gets pushed, and until they get that information, your file does not move forward. And if you've got a certain amount of time under the contract, that time is ticking away. Okay, most importantly, keep everybody in the loop, even if it's to say, I don't know anything. But let them know, let your client know, let the buyer's agent know, and inform the listing agent that you are making contact every week, at least once a week, and what's going on in the file, because silence makes people very nervous. There's a lot of nervous buyers out there. Cash buyers will just go and put an offer on something else. and you'll have invested all of that time and effort only to have to start over again if your buyer walks. How long is this going to take? I love this question. And it is very fact-specific because a lot of times it depends what lender you're dealing with. Some are easier to deal with, some are harder to deal with. If you want to know who's easy and who is hard, you can find me after this presentation.